Just carefully are talking about.
Thanks a lot, Bob. Okay. See you later, Bob Pisani. Rick Santelli's in Chicago with a little bit more. Rick?
Well, I have Bill Herr as my guest today, and you know, there's a lot of onward and continued talk about speculation and speculators being the bad guys. I'm sorry. Doesn't hold water, and Bill Herr has some examples of why we should look at it more from a factual standpoint. Give us a little history.
Well, you know, I had a college roommate of mine who's a CFO comment. I'm sure a bunch of farm traders got together and magnanimously started the exchange for the benefit of farmers. But that's exactly how it started. 150 years ago, they have booms and busts. You know, at harvest time, prices were low. Then we'd run out of crop, prices would skyrocket. So this enabled the farmer to smooth out their prices and plan, and the end user as well. So it really was for the benefit of both the farmer and the end user.
Now, let's switch gears and let's go to the financial side of the street. Can you give me an easy example of how financial futures make such a huge difference in our lives? And it's all via traders, speculators, and liquidity, but we never hear about this. Give me an example.
Well, it struck me that I could sell a $200,000 house and pay someone $12,000 to represent me and sell that house for me. A trader will move $100 million in euro dollars for $625.
And what do they get for that $625?
Risk. They get risk. Now, the end user, on the other hand, the people who want the 3.75 mortgage, they can lock in that mortgage because the banks and the lenders can hedge their risk.
Now, of course, the banks can abuse this, but what you're really saying is, you know, we see that these refis are down to a science. You can call up people, lock in rates, get 45-day, 60-day, 90 locks. Impossible without that pit, is it not?
Absolutely. And it gives us certainty, and it lets us borrow at low rates versus somebody borrowing at 5% in one town and 3% in another town.
All right, now let's switch gears back to commodities. You know, all this maligning of these traders, speculators, is there any example in the history of civilization where price controls in any arena have proven to be so good that they built a monument to it?
I mean, there's none, because what happens is when you take out the profit motive, the capital goes elsewhere. So if you try to control gas, the money will go out of gas, we'll get less supply,
or
prices
if
will go
like
higher.
In Venezuela or Argentina, you get huge corruption within the government as they take over these businesses.
And then massive inflation in
You know,
Argentina.
in the end, another example I always hear is, oh my God, look at the size of these positions now. Well, let me go to an analogy. Let's say I want to sell a piece of art at an auction. Bill, do you think I get a more fair price discovery if there were 5 people in the audience or 5,000 people in the audience?
5,000, and I think that you want more traders, not less traders. I can't go into it here; it's too long. But there's so many markets where there's only a few traders, and the markets are $5 wide instead of a quarter penny wide. And
you know, if we want to bring the price of oil down, let's really use all of the above, and let's think natural gas, because maligning these guys, it's a non-starter. Back to you.
Rick, thanks a lot. Rick Santelli in Chicago.